Hello, this is Dean Malone with CompositeX. I hope you're doing well today and you're getting some good trades. Over the last couple of days, we've seen the market pretty well flat. It's been very difficult for traders to make heads or tails of which way the market's going to go. And part of that is due to the weekly flow in the FX market has been pretty well dried up. According to one report by Reuters today, the weekly flow seen in the euro and in the yen have been down by 30%. The Swissie's down 25%, the Aussie's down 20%, and the Canadian dollar is off by 35%. When you have that much flow out of the marketplace, it makes it quite difficult. On top of that, when you have no U.S. news happening, that also makes it difficult for the market to get a feel for direction. Well, starting tomorrow, we're kind of back in the saddle. We will get the non-farm payroll numbers for September that should have come out the first week of October. However, with the government shutdown here in the U.S., that didn't take place, so we're going to get it tomorrow. And part of the volume flow being quite a bit off is probably waiting for the non-farm payroll. Now, before I jump right into the certain levels that I see where the market could go based upon the number we get, let's take a look at what the synergy model is telling us. Now, for those of y'all who trade the synergy model, what we look for typically is price action and market sentiment to have similar direction because that's a higher probable trade. What happens sometimes, though, is we get price doing one thing and market sentiment doing another. And what I see here is the chance to see the euro dollar rise tomorrow if the number comes in line or better than expected. Let me share with you what I see here. When the Traders Dynamic Index was going up, when price went up about mid part of last week, that's okay. They're both moving the same direction. But here we have a situation where price starts kind of going flat, and the Traders Dynamic Index obviously falls back over and gets all the way back down to neutral, right around that 50% line. However, when the Traders Dynamic Index was coming back down, price really didn't make that much movement. Price pretty much stayed in a fairly tight range of about 40, 50 pips or so. That's all. Whereas the Traders Dynamic Index made a pretty good move down from the 90s all the way down to 50% level. When this happens, this in effect is hidden divergence. And hidden divergence is an indication that the market has continuance in it. We're looking for the market to continue its upward trend. Now, this doesn't go in alignment with what the ECB is looking for. The ECB is continuing with the euro being at this high exchange rate, falling inflation, tightening of its credit. It would really like to see the euro come off a bit. But I don't think the euro is going to come off a bit unless we move into risk aversion tomorrow. So here's what the potential is that I see on the euro dollar tomorrow. Synergy showing upward movement because of hidden divergence. So where to? If the number comes in line as expected, right around 180,000 up to 200,000 or more, we could see this push to the 2013 high of 37.10, then possibly on up here to 138, and then a higher high we've seen in history at 138.80. Now that would be quite a bit of a push to get up there, but I think a number that comes in line or up around 200,000, we're going to definitely test the 2013 high and get above it. Some are estimating about a 37.50 figure, okay, because there's some offers and some option related business up there. Now, on the flip side, if it drops down quite a bit, then what we're going to be looking for is then a move back down to some previous support levels. And I wouldn't be surprised that the ECB might be involved in on that to see some relief on this high exchange rate on the euro dollar. And we could see the euro dollar, if the number was worse than expected, we could possibly see the euro come off due to risk aversion and then come down to this 35.60 area. Now, what do I mean for risk aversion? It's got to get down pretty darn low. It's got to get down below 100,000, down around 80 to 90,000. If that number comes out, we're going to see a movement out of risk on to risk off. You'll see the market start coming out of equities and higher risk asset classes into fixed asset classes such as bonds and treasuries. And typically when the market moves to safe haven, it moves back into the dollar and we see strength in the dollar. and then that coming out of the euro into the dollar, we'll see this potentially come down to this 35.60 area, possibly even push down lower to 135. And we have this pretty good floor right here back in last week that was right around that 34.73 that we took a pretty good push up on. That could be challenged as well, but I don't know. I think this 35 to 35.60 area might hold it. Some really in the marketplace want to hold the 135 and see a push up, so we may get a little contention in this area if we get a lot of risk aversion or risk off in the marketplace. So those are the levels that I have for tomorrow. Again, number in line or better than expected, up around 200,000. We see it break the 2013 mark, and we head up higher, 37.50, 38. If the market does risk aversion, the number's way off the mark, then we see it come down possibly to this 35.60 or possibly 35 or dip a little bit lower. Now, the pound dollar has the exact same look. Again, we've seen the Traders Dynamic Index moving up with price action earlier on last week, and then we've been flat. Look what the Traders Dynamic Index did. It came over all the way back down and below the 50% mark, but yet price just sitting here flat. Hidden divergence again, sign of continuance to the upside if the number comes in line or is better than expected. Where to? Let's take a look. If the number comes in line or better than expected, I see it breaking the 61.95, 162 area and then pushing on up here to 62.60. There's been a lot of talk about this level here. Above that, we test the 163 and potentially get up to the 2012 high around this 63.35 level. That's a possibility, but I see more likely to be in this area right here if we get a break of the 162. Now, if we get into risk aversion, worse than expected number, movement into bonds, treasuries, strengthen the dollar, people coming out of the pound, then we are going to go back down and test the 60.20 or 160 level, and then possibly make a push down to test the 59 level. This is the 58.90 that we had late last week as we saw a bit of a selling off of the pound and a pretty good little bounce back up on that. So I would see from a risk aversion standpoint a test of 160 and then a possible push down. 59.60 is a pretty good level though. That we've seen the market bounce around the 59.60 level in an attempt to get up above 160, then attempt to drop to 159, but yet kind of hold in that area. So those are my thoughts. The number would have to be way off the mark to the downside to cause that risk aversion in the marketplace and this safe haven play back into U.S. Treasuries and U.S. bonds. That would then give the big push down in both the euro and in the pound. Other than that, the number's in line. Look for both the pound dollar and the euro dollar to make their push up, as I pointed out in this video. Y'all have a great day. Get some good trades. We'll talk to you next time. Bye-bye.